Hi, my name is Scott O'Neill. We want to thank you for purchasing this Level 2 Home Study Kit. It should be a great addition to your investment library. I, along with some of my colleagues, will take you through this course. Our starting point will be to review the psychological aspects of the stock market. As you are probably aware, the stock market has many emotional components to it. We believe investors have to look at the stock market a certain way if they're going to be successful year after year. So let's open the workbook and start with Section 1, the Foundations for Investing. Number 1. Bernard Baruch, an accomplished investor, once said, "The stock market is human nature on parade." What he's referring to is that we're all human, we all have emotions. The problem is that those emotions in many cases will betray us at critical points in the stock market. So we have to figure out a way to separate our emotions from the investment decision-making process. A good way to do this is to do a post-analysis on your trades. Take out a chart, plot your buys, plot your adds, plot your sells, and look at what you're doing. And you'll see in many cases when you lose money, you'll see that you are swaying from the rules. The emotions took over. Now, there's one other reality. If we're going to be successful year in and year out in the stock market that we have to accept, and that is that the stock market is bent on fooling the masses. Number 2, what works in the market is contrary. It's contrary to the way normal, intelligent people think. It's 180 degrees the opposite way. That's why most people have trouble with the stock market. We must operate on rules. Rules in order to compensate for the market's cunning behavior. Most investors do not operate on rules. They don't realize that you must operate on rules. Number 3, the market operates on 2 basic emotions, fear and greed. Now, I know everyone has heard that many times. We believe that you can never hear that too often because in the heat of the battle, when you're feeling pressured, that's when the mistakes occur. You can veer and make a quick mistake that will be costly. The market operates on fear and greed. The problem is most investors mix the two up. For instance, let's say a stock is down. The typical investor is going to hope that that stock will go back up. They can possibly sell it and break even. Well, they really should be fearing that that stock will go down further. Why? Because, as we know, stocks trend. They tend to trend. So the probability of that trend is to go down further. You see, it's all psychology. It's all human emotion. We must control our emotion. Here's a good little example of what we're talking about. Ego comes down to hope, fear, greed, and pride, and then you can look, hope. They don't cut their losses when they should. You know, there's an old saying, the first loss is the smallest loss, and some average down. Pride, because I'm prideful, I'm not going to cut my losses. Number 4, the best way to take emotion out of the investing equation is to have a proven system. System with sound rules to follow. When you're scared, when the screen is totally red, when you open up IBD and you see all the stocks you're following are underlined, your drawdown in your account is really starting to bother you, you can't go on how you feel. You've got to have rules to help you navigate. When you're not sure, turn it over to the rules. Now, the same is when you're up big. Let's say the screen is totally green. Stocks are bold-faced. Your equity is soaring. You need rules to keep you grounded. It's too easy at that point in time to start getting sloppy or greedy. You know the old saying, bulls and bears make money, but pigs get slaughtered? Number 5, the CanSlim investment system is based on fact, not opinion. None of Can Slim is our opinion, unlike a lot of Wall Street's research. We simply observed the market itself and we documented our observations. What we did was we looked at the greatest winning stocks from 1950 to today, and we built models of them. And we looked at what were the common characteristics of all of these great winners just before they exploded and had their big move, and what did they look like, what were the common characteristics when they all topped. And from all of this research, we developed our rules. Our buy rules and sell rules are based on the reality of the marketplace. So really, they're not our rules. They're the market's rules. Here's an example from this research. We found that when a great winner tops, because they all top at some point, they will drop on average 72% from the peak to the trough. Most people don't know that. Wall Street doesn't seem to talk about a statistic like that. What advice do you get from friends or Wall Street? Let's buy on the dip. All the while, you're buying on the down slope. See, we have rules that will get you out near the top, that will keep you out of the market when you should be out, and will get you in when you should be in. Let's look at a couple charts real quick. Here's Yahoo back in January of 2000. And here are some of the comments that were out there at the time. One analyst says, over the near term, don't sell positions, stay the course, look for dips. There it is. January 12, 2000, 3 firms raised price targets, one adding, it's not prudent to chase Yahoo at these levels, but rather to buy on dips. Where did it end up? Well, up at the top here, it's at 250, and it went down 97% in 20 months. This is that drop on the back slope. Let's look at one more. Qualcomm. What a great stock that was in its day. December 29, 1999. Analyst raises price target to 1,000. That's an equivalent of 250 after the split. Where did it end up? Down 88% in 31 months. See, rules versus emotions is a critical piece in this game. Rules, discipline versus emotions. That's what it comes down to. We've got to separate those emotions. We can't stress that enough. Number 6, mistakes made in the market are really just tuition. Tuition payments to the School of Wall Street. I know it sounds kind of funny, but we all make mistakes. You're going to make mistakes at this. I make plenty of mistakes. Bill O'Neill will tell you in a second he makes plenty of mistakes. That's actually not the issue. The issue is how long does it take you to recognize those mistakes and how quick are you to fix them? Then obviously you don't repeat them and you move on. So you incrementally, year over year, get better and better. The reason most investors lose money or achieve mediocre results long term is that they make too many mistakes. It's the mistakes that undermine us. We believe it takes 2 to 3 years for the typical investor to make all of the classic mistakes. For instance, buying extended, buying too much. Your group concentration is wrong. Decisions made on emotion. Holding losing stocks. Now there's an interesting one. I don't know how often I have heard it's a good company and I'm just going to hold on to it while it's tanking. Buying when not in a base. Moving too much money into the market too fast. Buying cheap stocks. I don't know why some people are so enamored with buying dollar stocks. Statistically, it's proven that when you're down there below the teens, you have a lower probability of success. Plus, major mutual funds And hedge funds typically can't get a sizable position down in that area, so they avoid it altogether. It's a long list of mistakes, and everyone has to go through it firsthand. But once through it, we believe that your results will improve dramatically. You see, you have to be able to recognize and not repeat these mistakes, and that is much easier said than done. Why? Because those mistakes are our human nature. See, back to number 1. So the best way to uproot these kinds of mistakes, to put them to rest, is to analyze our trades. Again, do a post-analysis so you can look at what you're doing in the market. We believe that this analysis, the payback on it is tenfold of what you put in and what you get out of it. The stock market is a skill thing, like tennis, writing, the piano. It takes practice, repetition, practice. We know that. Well, the stock market is no different. You're chipping away at getting better and better over time. You see, it comes down to knowledge and skill. Simply put, you get out what you put in. Now, the better you get, the fewer the mistakes you'll make, but I'll go one further. You will begin to recognize your mistakes sooner, correct them faster when they're cheaper. That way, the big winners will really count. Number 7. Number 7 is the most important rule of all rules. We've been talking about it for at least 40 years. I will cut every loss at 7 to 8% when down from my purchase price. Don't think, don't rationalize, don't argue with the market, don't explain it away, don't hope, just sell. Now, how do we come up with this rule? Go back to the great winners. We went back to the model books and we found that if you buy a stock right in a bull market, it's emerging from a consolidation point with volume, it will very rarely ever go down 7 to 8%. So the real question is, how's your chart interpretation? If you follow the 7% rule, what is your maximum risk on any stock at any time? 7%. What's Wall Street's advice in this situation normally? Sit. Buy more on the dip. It's a big cap. It's corporate America. Or an investor might say, that's okay that I'm down. I'm a long-term investor. Or how about the person that says, well, I'm getting my dividends, so I'm happy. Okay, you're getting your 3% dividend. Your stock is showing a 30% loss. Won't your statement show a 27% loss? And my all-time favorite, it's a good company. It'll come back. In 1970 to 1973, Eastman Kodak was a fabulous company. The chart pattern was incredible. It had what we call a monster move. Admiral TV, many people probably remember Admiral TV, back in 62 to 1967 had a fabulous move. Levitt's Furniture, 67 to 71, had an incredible monster move. Where are these stocks now? You see, all stocks are speculative. All stocks are risky. Number 8. If I buy 10 stocks, I will most likely be wrong on 4 or 5. Know this up front. If we know that that is baked into the cake, then won't it make it easier for us to accept when we're wrong? And so therefore we can correct those mistakes faster? Now, how do you know when you're wrong in the stock market? Your stocks are down. See, the secret is to lose the least amount of money when you might be wrong. And we're all going to be wrong in the stock market a lot. It's just part of the game. Number 9, the faster I admit I am wrong in a stock, the faster I will stop losing. losing money. See, here's the equation. We want to lose the least amount of money when we might be wrong, and we want to make big money when we're finally right. It only takes 1 or 2 stocks in your portfolio to make a big year if you keep your losses small. Now let's go back to the 7% loss cutting rule for a moment. I have an interesting twist. Let's say that you cut your losses at 7% always. You don't have a problem with that. But one time, a stock that you cut at 7% turns around and goes right back up. What might the typical investor's thinking process be going through that situation? Well, gee, I can't believe that, I sold this. It's a great company. I did all the research. It's got the CanSlim characteristics, and, I don't know about that 7% rule. Well, here's the trap. Half the time in that situation, the stock will go back up. The problem is, the other half, it will go down, it will keep going down, and it won't stop. You see, it's irrelevant if your stock goes back up, because your objective is to keep every loss small to live to invest another day. We can always buy the stock back, can't we? Number 10. If I have a 25% loss, I will have to make what to break even? 33%. A 50% loss requires us to make 100%. And here's the one that wakes everybody up. Number 11, if I have a 75% loss, I will have to make 300% to break even. Now, what did we just talk about? The greatest winning stocks, when they top, they will drop on average 72%. This kind of a loss can bury you for years. Worse than the dollar loss is the damage to your confidence, which you have got to guard always. Because if you lose your confidence, there's a chance you will hesitate at a critical point in the market. Wall Street has a slang for this. There's the quick and there's the dead. We have a perfect analogy for this situation. Did you buy fire insurance on your house last year? Did your house burn down? Are you angry that you wasted your money on the fire insurance because your house didn't burn down? Why did you buy the insurance in the first place? You bought it to protect yourself against the remote possibility that you could be wiped out. And that's what the 7 to 8% loss cutting rule is. Catastrophic insurance. How often do you buy a stock that doubles, triples, let alone quadruples? Not often. So you can never let a stock go down 50% on you. You get so deep, you can't get out. And then, of course, your confidence starts to get shaken. See, the market doesn't care what we hope, what we want, that we think our stock is undervalued or oversold. The market is simply a supply and demand mechanism. If there's a large supply of stock made available and there are no buyers around and you happen to own that stock, you're going to get hurt. So we have to be able to recognize unusual weakness and get out. Now we have an image for this. Let's say you have a 7% loss. You have to now make 7.5% to get back even. And you go down the line, and there's the 75%. And a lot of investors forget these numbers. And as I said, making 100, 200, 300% is awfully tough. We don't want to be put in that situation. How many people have been put in that situation because of the 2000 bubble bursting? Number 12, all stocks are bad unless they go up. They have to go up to be good. I know this sounds simplistic, but it's really true. If your stock's not going up, it's a bad stock, regardless of the story. Here's a slide of United Airlines. A friend of mine purchased it where the arrow is, and he was very happy with himself. He said he bought a great stock cheap. He bought the pullback. And here's where it went. Why do investors sit with losing stocks? I believe it's back to human nature. We don't like to be wrong. And we didn't buy a stock to lose money. You see, we cannot have favorites. If your stock is down, it's a bad stock. Now, I don't want to scare anyone. I believe my job is to paint a very real picture of how it really is on Wall Street. Because if we understand how it really operates, then we can build a strategy to handle it. Now, we spent time on defense. Let's flip the coin over to offense. Let's look at making money now. Number 13, I will let my profits run. Run. If you're up on a stock, your immediate reaction should be back off, give it some room. You don't know what that stock can do at such an early stage. Now, that is assuming you're buying properly as that stock's emerging from a sound base. Most investors will buy a stock at 50, and when it goes up to 52, they will sell it out immediately, fearing that the market will take that small profit away from them. When in reality, they should be backing away and giving it some room because it appears that they're on the right track. Now, selling is tougher than buying. I think most of us would agree. So we have one rule that will make the process mechanical and hopefully help you. It's a rule for you to consider. If you're up 20 to 25% on a stock, consider taking most profits then. Most stocks will go up that amount and consolidate those gains at that new level anyway. Now, what this will do is this puts the number in your favor. We call this our 3-to-1 ratio. 3-to-1 profit-loss ratio. You can be right 1 out of 4 times and still come out ahead. Now, on the left, you get a 25% gain, you have 7% losses, your portfolio's intact. On the right, same thing. You make a 20% gain, you have 7% losses, your portfolio again is basically intact. You're in a position of strength, your confidence is in check, you have not been hurt, you're ready for the next investment idea. Now, we have one exception to this suggested rule of selling and taking a profit at 20 to 25%, and that's number 14, which says if I own a stock that goes up 20% within 3 weeks, I should hold it for at least 8 weeks. Now, this rule assumes that you have a growth stock on your hands that is a classic can slim stock. It's a group leader, that you have quality sponsorship, and of course you're in a bull market. Now, you remember a little bit earlier I mentioned you have to be able to recognize your unusual weakness. We also have to be able to recognize unusual strength. So most stocks, we're going to lock in our gains at the 20% area, but if one runs up rapidly, we're going to play it out for a larger gain. Here's an example of Certainteed back in 1961 where Bill O'Neill bought it. Notice the aggressive pattern up and then the sideways action. We have a high tight flag here. And then it breaks out. And he interprets it correctly. And as it goes, in its 6th week, it all of a sudden has a sharp pullback and it scares him out. Then, after he's shaken out, it turns and it triples. So, being a good investor and not happy with his results, he did a post-analysis on the trade. And then he compared his findings to other model book stocks that had big moves to see if some of his theories were consistent with other stocks. And he found that some great winners would pull back to the top of their base after they break out, that was actually normal behavior. So he comes up with a rule. If this stock jumps out and it's up 20% within the first 3 weeks, that is unusual strength. There's something going on here, possibly. So I'm going to hold it for 8 weeks because that gets me through that rough patch until it's up and off the runway. Well, along comes a stock called Syntex in 1964. It has the same aggressive pattern, the same high-tight flag. It emerges from that base. He sees it. He makes his purchases. And by coincidence, in the 6th week, it does the exact same thing as Certainty did, except this time, Bill is armed with a rule. If it does this, I will hold it. And in this case, if it does 20% within 3 weeks, I'll hold it for 8. So he holds it for 8, and it gets him through that rough patch. You see, there's no thinking now at all. You've completely turned it over to the rules. It's on autopilot. I've got to sit for 8 weeks. And the only way to break that rule is if the stock completely breaks down and the 7% rule, which is that safety net down below, gets triggered. But in this case, I doubt that would really happen without some extraordinary event or announcement. At the end of 8 weeks, this stock is up 63%, at which time he forms a 6-month rule. I am going to sit with this stock and let it go for 6 months and see what happens. I might have a big winner on my hands. It's certainly acting very powerful. Also, the reason for the 6-month rule was back in the 60s, you may remember that capital gains was exceedingly high, and so he made the 6-month one-day rule so he could get over that hurdle. Well, at the end of 6 months, he was up 550%, and this was one of the key stocks that put him into business. He used the money to buy a seat on the New York Stock Exchange floor. Now, in discussing this case study with him, here are a couple of comments from Bill O'Neill. This was the most important analysis discovery of that time period that I made. He's referring to this 8-week rule. And referring to Certainty, I had a huge winner and I got scared out. And here's what I think was the key in the conversation. He said, if you go on how you feel, you'll never hold on. Number 15, the market is always right. Right. Only the market will tell me what my stocks are worth. Let the market tell you the way it is, and you adjust accordingly. It's no big deal. You see, if we always agree with the market, won't that make it easier for us to stay in phase with it? So our job is to figure out what the market is doing and go along with it. Never think that you're smarter than the market. That can be very costly. Number 16, price to earnings ratios, PEs, were proven not to be a cause of outstanding stock performance, but rather an end effect or end result of excellent and improving earnings. Earnings and sales increases. Keep your eye on those. Stocks follow earnings. Now, PEs are the very foundation of Wall Street. The stock market is an auction marketplace. Everything sells for what it's worth at the time. What advice do we get from Wall Street typically? Buy this stock because it has a low PE. Sell that stock because it has a high PE. This stock is oversold, etc., etc. Those are all opinions. Those are personal opinions. We, in fact, don't look at PEs on the buy side. Stocks sell for what they're worth. Great winning stocks, PEs are higher because those stocks are in demand. The funds want them. We all know how many funds there are in the world. And what we're talking about is a small universe of stocks that are truly outstanding. And most of those funds and hedge funds want those stocks, so they're bidding them up. That's why they have a higher PE. Here's a quick example of this. AOL, back in 98, the PE at the pivot was 205. How about Amgen, back in 1990? The PE at the pivot was 48. Amgen went up 681%. AOL went up almost 500%. NTAP, a squirrely stock at the time, 142. A lot of the great winning stocks start with a higher PE, again, because they're being bid up. A good analogy we have is ask yourself, looking at your portfolio, how many Jordans, Michael Jordans, do you have in that portfolio? Or do you have a bunch of rookies? Well, as a coach, you could have Michael Jordan on your team. You'd have to pay a lot for him. Or pass on Michael Jordan and get a couple of rookies because you'll get several of them for the same price, won't you? What will your results be? You see, you get what you pay for in sports and life, and you get what you pay for in the stock market. Passing up a leader because its PE is too high and buying a laggard because its PE is low is exactly backwards. We're not looking for bargains. We are looking for the best. We want to buy the best stocks in the best industry groups now. So back to that question. How many Jordans and how many rookies do you have in your portfolio? The stock with a PE of 21 is worth paying 21 times earnings. The stock with a PE of 50 is worth paying 50 times earnings. We are not going to be able to buy a very expensive high-end car for cheap. That's backwards. See, the market doesn't care what we think, or that supposedly this stock is undervalued or overvalued. The market obeys the laws of supply and demand. That's it. In closing, you have to have rules. Rules to protect you and guide you. Every human frailty comes out in the market. The market preys on them. You have to be flexible. Never plant your flag in the ground and say, I know this is a good stock. I'm going to hold on to it. It'll come back when you're down 40%. We follow facts. And as the facts change, we change.